Hey everybody, what's up? We are back with another stock analysis. Today we'll be looking at CrowdStrike. They are one of the largest IT and cybersecurity companies in the world. One of the fastest growing over the past few years. So they just released their earnings about a week and a half ago. We're going to be getting into that, seeing what they are going through at the moment, and giving an update on the company. I think I reviewed them probably about a month or two ago. I'm not really sure. But we're going to look through the financials again, look through that recent earnings report that they had, and give you an idea of where the company is headed currently. So, saying that, make sure to subscribe if you are interested, and let's get into it. So, first off, I think most people sort of interested in the stock market know about CrowdStrike. Massive cybersecurity company, a ton of different software related to that. Anyway, they can see a fairly large increase in billings over the next, looks like they have 2 years of estimates here, which is pretty cool. Backlog value is also expected to grow as well. Average revenue per user is showing some mostly consistency, no real changes there. RPO is revenue per something. I don't really know what it is, but it's going to increase, which is great. Total is also increasing by a lot as well. Again, I don't know what RPO means. But it's increasing, which I believe is good. Revenue per something, I'm not sure. Market cap is currently at 86, just about $1 billion, which is pretty large. They were just recently over 100 billion, which if we look right here, this is their stock over the past couple weeks. So they topped out in the end of February. And since then, they've been dropping pretty hard along with the rest of the market. In my opinion, I would say this is probably a very solid undervalued opportunity for them. You could also see one thing to really notice here is how much their workforce has been growing. So just about 4 or 5 years ago, they had 2,000 employees. Now they are at over 10,000. And I think that's kind of indicative of where the company is sort of growing from. Massive increases in their overall workforce, which I think will definitely translate to the performance of the company in the future. So target price is at 412. We have an 18% long-term growth rate. We are significantly below that target price as well. That is about a 30% upside at the moment, which is pretty significant. You could see they have had a massive run up in the past few years. So, although it does look like a fairly good buying opportunity right now, this company is definitely overvalued. Their sales growth is massive, to be fair, but it is going to be a while until they can really catch up to where they're making enough money to back up their valuation. Hopefully, their PE ratio is a bit more manageable within like a year or two, but right now it is sitting at right around 101 PE ratio, which is insane. But that's mostly because they are just in the process of kind of monetizing themselves. So their net income for the next year is projected to be just under a billion. I think that will really help to switch up this valuation situation a little bit. Looking into the estimates, they are very mixed. I don't know where they got these numbers from, but I would honestly say they're almost completely false. This company is becoming profitable very quickly, and I doubt we're going to see their net income drop off anymore. Sales are showing some very strong increases, which I think will definitely happen. Same thing with free cash flow. But overall, all of these decreases in the middle, I'm probably going to say they just haven't been updated in a while. But either way, I don't think that will occur. Um, anyway, getting into the earnings now, let's see how their last report went. Um, Also saying that I am not invested in this company at all, just to be clear. But either way, let's see about the metrics recap, and then there should almost okay, there is a street takeaways as well. So we're going to start off with the metrics. So subscription revenue came in above. Same thing with services. Recurring revenue came in above as well. Gap margin beat. Cash from operations was ahead. Deferred revenue is higher as well. Okay, so they beat on every single financial metric they have. Let's take a look at what the analysts are saying. So sentiment was positive. Subscription revenue was up. ARR was up despite competition. Stock is down on disappointing first quarter 2025 and the fiscal year margins, which is kind of understandable. I get it. But either way. Oh, actually, fiscal four quarter. Oh, is this their is their fiscal year 2025 like a full year ahead? Is that what's going on here? That could be what it is because I keep seeing like 2025, and I guess that kind of makes sense. Fourth quarter 2025, is that what that is? So their fiscal year is a crazy way off. So their fiscal year 2026 is actually very close to starting, which is insane. I don't know why they would organize it like that, but either way, um, everything looks fairly positive. It looks like the guidance was a little bit short, but either way, price targets were increased, outperform $400 price target. Actually, one was lowered and this was neutral. So the overall, they actually don't have the overall rundown of price targets, but I would say there's more positives than negatives here. Obviously, there is a fairly large consensus that the company is overvalued at the moment. However, I think they're going to be growing into that fairly soon. Based on where the price is right now, I would say that they probably have some more dropping room that they can kind of fill into. Um, if it does hit this kind of 250 to maybe just upper 200s range, I would definitely perceive that as being a buying opportunity, just because of how low it has gone. But overall, I would also say that it's definitely high risk just because of that PE ratio being so much higher. If we look at their competitors, let's actually see what their competitors' PEs are compared to them, which we should be able to get some here. So, valuation PEs. So, for the current fiscal year, they are at 98, and the average is right around 46. So, they're essentially doubled from that, which is not great. They are expected to kind of lower that PE next year. However, that also comes with a lowering of the average with their competitors as well. So, is that really compared to their sector? I would say that's still not great, but at least they're kind of growing into their own valuation. But either way, it's going to be a little skeptical. I'm just going to glance over the overall financial statements here just because I feel like I already reviewed all of this not too long ago. So looking at the fiscal year, okay, so their fiscal year 2025 is done already. I don't know why they organized it like this. The way their fiscal years are set up, that seems a little strange, but either way, massive sales growth. Operating income was negative compared to the year before. Same thing with net income. I honestly think that they, again, this is just a thing they have to grow into, but they're seeing the growth, they're seeing the results. The sales kind of speak for themselves. So overall, I think it will be positive long term either way. Total shares are still increasing, which again makes sense. They're not really consistently net profitable. So we are going to see the total shares continue to go up. Looking at their balance sheet, their cash situation is honestly very good. They have very little debt overall, and $4.3 billion in cash currently. Assets are also at a very strong all-time high as well. Almost no short-term debt at all. So moving on, cash flows. Um, Operating cash flows look good. We're seeing an all-time high there as well. A lot of acquisition activity going on the past 2 years, which is pretty good. Hopefully, we will see increased benefits from that. And honestly, we kind of are with how the sales are increasing already. Financing activities are showing as negative just because of that little bit of stock selling that they're doing. And I don't think that's a major thing. It honestly kind of makes sense to take advantage of where their stock is currently to, while they're super overvalued, to kind of take advantage of that position and get more money out of it. So that does kind of make sense. Free cash flow is also at a very clear all-time high. So overall, I would say we're seeing a lot of good things. Just need to see profitability growth at this point. And we did see year over year, some of those margins declined, operating margin, net margin as well. But I think this is just kind of a growing pains thing that we will kind of see them work their way out of. Debt to equity is also very low. And yeah, that's all I have for CrowdStrike today. Just wanted to do a quick glance over everything that's been happening with the company just to stay a little bit more up to date with them. I think a price target for a buy would be somewhere around 260 to 250 at this point. But either way, do your own research. Make sure to look into this for yourself. And yeah, thanks for watching. Make sure to subscribe if you haven't. And I will see everybody in the next video.